Are you curious about what a mortgage point is, how it works, when it's best appropriate for your situation? I'm Erica Carlson. I'm with a boutique brokerage called Bricks Real Estate. And this week I have Molly Zimmerman back from Bell Bank Mortgage to talk about this and how it might apply to your situation the next time you purchase a house. Towards the end of my video, I will share real estate market update for the entire Twin Cities. And just as a hint, I'll tell you that we are becoming more of an equal market, meaning not fully a buyer's market and not a seller's market. But of course, I'll go into further detail. So without further ado, let me bring Molly on to talk about mortgage points.
So mortgage points are a fee that you might pay to buy a lower interest rate on your loan for the life of that loan. So for example, you pay a one-time fee up front to get a lower interest rate for the term of 30 years or whatever your loan term might be.
Oh, so then how does that work for somebody?
I guess if I'm working with a client and we're talking about different rate cost options, I do like to present them with par rate, which is your typical market interest rate, and then potentially a couple different buy down rates, which would be, maybe paying a 0.5% of your loan amount to buy a lower interest rate, but then also maybe 1%. So as you go lower in interest rate, you're going to spend a little bit more upfront in cost to buy that interest rate. So just like thinking generally, like say you have a $300,000 loan, if you looked at paying a 0.5 point, you'd be paying $1,500 in addition to like your standard fixed cost to buy a lower interest rate. And if you decided to pay a full point, you'd be paying an additional $3,000. So then you kind of have to look at like the difference between how much money am I spending? What is that going to save me on a monthly basis? Does it make sense to spend that money or not for that lower interest rate?
Like, is there a time where it really doesn't make sense for people to buy points?
I think as a society, I feel like we're very programmed just to think that the lowest interest rate is always the best. So like if I get a phone call, it's always, what's the lowest interest rate you can get me? And that can be a loaded question because I might be able to say, hey, I can get you this interest rate, but you're going to spend $15,000 up front to buy that interest rate. So for me, it's how long are you going to be in the house? Do you have the money to cover some sort of a buy down? And what's the most important thing to you? Do you see yourself refinancing in a couple of years? Do you see yourself being in this loan for a full 30 years, the full term? There just are a lot of things for us to talk about to see if it makes sense to buy down.
Absolutely. I definitely think this is like a topic a lot of people, once they know about it, it's a great tool and easier to have that discussion. But I would say it's like the number one thing that comes up when I first meet people when I'm talking about, well, here's the rate with points, without points, and all of a sudden you hear that, what's the point?
Right.
But then I see people like take it too far to your point of like, are you really going to spend $15,000 to get that rate? Like that just probably doesn't make sense. Maybe just to kind of conclude this conversation is maybe we could give people an example of like a real life, like how this works, maybe.
Yeah, so I think we were kind of discussing on the side, like a 400,000, let's say you're taking out a loan for 400,000 and you decide to pay 1 point, which would be $4,000. And let's say that maybe got your rate down a quarter of a point and saved you $50 a month, just, generally speaking. I would look at taking that $4,000 spent up front, divide that by $50 a month in your savings to determine that you would want to be in that loan for over 6.5 years for that buy down to make sense in that situation. So it's really taking the upfront cost divided by your monthly payment savings and coming up with a timeline. And then looking at that timeline and saying to yourself, do I see myself being in this loan in 6.5 years? If the answer is no, it probably does not make sense for you to spend that $4,000 up front for that lower interest rate.
Mm-hmm. Yeah, this was a really helpful conversation. I think if people have questions about this, we certainly can be there to answer these questions, and we'd love to get the process started. I mean, everybody's situation is going to be so different. So to all the things you just mentioned, it's like whether buying points make sense. It's going to really depend on what you're buying, your price point, just like you said, how long. I mean, that's a little bit of a crystal ball question, but giving us an idea if it's your 20-year house, your 2-year house, that's going to make a load of difference. Well, thanks for joining us today, Molly.
Yep. Thank you.
I'm going to record this rather quickly, and I encourage you to just pause the video to read this to yourself if it's easier. But we're going to start with the graphic here on the Twin Cities market meter to just give you an idea that we are slowly moving towards a more balanced market. We've been in that buyer's market for a while, but we definitely think things will pick up after the holidays, which here is just, a week away. It's really just not that far away. And at the top, you can see historical information if you find that interesting. Looking at showings per week per listing, the average of the 250 to 500K, which we've looked at many times before. Now, this isn't just for Wright County, this is for the entire Twin Cities market. We're sitting at about 3.34, which isn't a very helpful number. So that means about 3 showings per week in the Twin Cities area. That is a hair faster than the week before, which I honestly can tell you I could feel it. Like, it actually felt a little faster this past week. More calls, more interested people in getting out there and looking at houses. Probably just a coincidence of timing. And then again, you've got that historical data if you're curious about it. Inventory of homes is lower than even last week. And again, as we get closer to the holidays, more people start pulling their house off the market because they're becoming shy about the holidays. Some people will relist or take it out of this temporary status where they kind of hold things and don't want showings. Days on market, we're still sitting around 45 days. I think that will decrease as we get past the holidays. And then in terms of interest rates, now this isn't for any particular lender, but we're sitting at about 6.93%, which is a little bit higher than last week. And you can see even higher than a year ago. So if you have any questions about this or anything else we've talked about today, feel free to reach out to me. The link below will bring you to my calendar in which you can pick the best time that works for you. And if you have any financing questions, please don't hesitate to reach out to Molly. Have a great week.